Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now for some discussion about the Fed and inflation and the markets is Mr. Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, great to have you on the program, and thanks for doing this on a Sunday. We do appreciate it. I want to talk to you a little bit about the Fed. The stance that we heard from Jerome Powell, it seems to be part hopium, part rational analysis, it's to be fair, and maybe just part patience. I'm curious your take on where we are now in the balance between inflation and jobs.
Well, first of all, good morning, Brian, and sorry to hear you had a sweaty weekend. There is definitely that hopium element in this whole thing. You had Larry Summers on Bloomberg TV, on Friday night our time, basically, saying that he doesn't understand where the Fed thinks the neutral rate is, and I didn't express it quite so eloquently, but I've been getting at the same point in some of the work I've been doing, which is, we've got all this fiscal expansion. You look at rollicking stock markets, you look at bond markets doing fine, still pricing in big cuts. You look at heavy speculation in things like Bitcoin and gold and other things that are non-interest-bearing assets. And you have to wonder, why do we actually need interest rate cuts, especially if the summary of economic projections is now up to 2.1%, which tells me a recession isn't in the cards either. So, yes, there's rational analysis, but I do have to think that he's feeding into this idea, this urgency that we need to get to a more neutral rate without telling us what that neutral rate is.
Yeah, back to Larry Summers. The one issue I would take with his comments is, he's saying, why is the Fed in such a hurry? And actually, the Fed did not say they were definitely going to start cutting rates by the summer. They said that they were watching the data and that they thought that the 2 months, January and February, were a couple of months. That's it, a couple of months, just like they didn't overreact last year when disinflation was happening over a period of 7 months. They still hung in there with their rate hikes and said, well, we'll see. That's still what they're saying, right? We'll see. So that's why I think the patience comes in. And should we doubt his word that if the inflation stays hot, that they'll wait longer or that they could even hike?
I don't doubt his word. I'm not going to say that about Chairman Powell. But the thing I don't think he appreciates is if he says maybe, the market hears yes.
Okay.
And that's I think really where it really stems from. Think about the reaction to the December meeting. He confirmed that 3 rate cuts would be in the cards potentially for 2024. The market heard 6. And so this is I think what he doesn't necessarily reckon with when he speaks publicly, or maybe this is what he wants because it just keeps confidence high and maybe actually reduces the need for the Fed to do anything. Maybe that's the goal, but that's where it comes from.
Yeah, you definitely got a point there. There's this too. I'm curious whether the Fed and even the Biden administration should be getting a little bit worried about the oil price here. It has been creeping higher. We heard from the IEA about 10 days ago. They increased their demand forecast and they reduced their supply forecast. And, that could become an issue too, right?
Oh, absolutely. When I've tracked this several times, where I look at the consumer expectations for 1 year inflation, it pretty much tracks the price of gasoline at the pump.
Yeah.
Almost perfectly. And so yes, that's a problem. If prices at the pump go back up, that's not good for the Biden administration. And a strong economy lifts gas prices because there's more demand for energy.
We do have a story on the terminal that suggests that investors are back to putting on trades now that will benefit from a cut in interest rates, and not just citing the Fed, but also the ECB and the Bank of England and others too. How are you positioning for the sort of play over the next few months?
Well, one of the things that I've been referring to, because I've seen this trade to a large extent, and I call it FOMO insurance. What we see in the options market is definitely options pricing in more aggressively purchased to the buy side than to the downside. And yes, there's a lot of speculation in options, but still the options market is the best place for institutions to put on hedges. Except the thing that they're hedging is their FOMO. They don't want to miss a rally. So if you've got NVIDIA at or near all-time highs, or pick your product at or near all-time highs, you may not want to be putting a lot of capital into it, but you may want that upside. And we're seeing a lot of traders and investors basically buying the upside so that they don't have to put a lot of money into products that are at or near all-time highs, but are performing so well that you really can't afford to miss it.
We've got some time to circle back, but I want to get a question in on Japan and China, and then if we have some time, we'll come back to the general thrust of things on investing. In Japan, Chris Wood's a guy that I have read for 20 odd years at Jefferies, used to be at CLSA, and he spent some time in a piece out late last week talking about how all of a sudden you're seeing interest from domestic Japanese investors in their own stock market, and they've been net sellers for like 20 years. And you know, I ask you the question now because the Nikkei has rallied a lot and people are wondering, well, you know, I don't know. Has it gone too far? Your thoughts on Japan?
Well, I think what you're seeing in Japan is human nature as it refers to the stock market at work. I mean, you know, supply and demand has an upside down curve. It's really pretty much the only thing I can think of where the demand goes up as the price goes up. It's completely the opposite of what we learn in Economics 101. And I think, you know, after 20 years of being beaten down by the stock market and its lack of performance, I think it's quite encouraging to see Japanese investors looking at their domestic markets, although it probably would have been nicer if they'd been looking at 20,000 than starting to look at 40,000. Yeah. The other piece of anecdotal evidence I'd heard, and I can't put a number on it, but I think it was Eric Balchunas who reported it, that the Japanese government, thanks to all their quantitative easing, owns about 70% of the ETFs in Japan. Yeah. And that's going to be interesting because at some point, you'd like to think that the Bank of Japan would sort of take the profits on this and release those back into the market. Does that put a ceiling on things, or do they let things get a little euphoric if you've had international and domestic investors coming back in?
Okay, now a place that hasn't gone up, and we can't talk about the greater fool theory, is China. We had the Premier Li Qiang opening up this key development forum. A lot of big-time CEOs there, including Tim Cook at Apple. But his basic message is to play down the concerns. The Chinese economy is okay. How are you playing that?
You know, I'm not one of the people who believes that China, Greater China is uninvestable, but it's certainly, since the world is in love with momentum trading right now and momentum investing, China's basically zagging while the rest of the world zigs. It's moving sideways. On the one hand, I guess if you believe in international diversification, you're diversifying if you invest in Greater China. The problem is it's really the one set of, Hong Kong and mainland are pretty much the one set of markets that are not at or near all-time highs. And so, if you're a value player, there's definitely good values.
All right, there's some possibility. Okay, Steve, thank you very much. Got a homebrew coming your way one of these days. Steve Sosnick from Interactive Brokers. Take a closer look at the Fed and interest rates and the U.S. economy with Mark Heppenstall, President and CIO of Penn Mutual Asset Management. Mark, is it safe to say that the Fed is well into now starting to think about jobs more and a little bit less about inflation? And how do you think the balance is at the moment?
Well, Brian, good to be with you this evening. I do think that last week's Fed meeting where Fed Chair Powell, I don't want to say he necessarily dismissed the recent uptick in inflation, but I will say it is hard to reconcile, I guess, 3 rate cuts this year in light of the projection that the Fed made last week that inflation wasn't going to hit their 2% target until 2026. So, there's been a lot of talk about whether the inflation target may, in fact, be more of a range now as opposed to a precise target at 2%. But I do think that, last year they seemed to be willing to sort of accept the fact that there was going to be some pain necessary in the labor market. And thankfully, that has not at all been the case with more than 500 basis points of interest rate hikes. But I do think that I would say that sort of dynamic between inflation and employment in the dual mandate is much more in balance than it was, let's say, at this point last year.
Well, we had 7 months last year of disinflation, pretty strong disinflation. We had rates coming, or actually inflation coming down pretty solidly. It wasn't at the target, not even near it, but it did come down a lot. But I'm curious why so many people now think that the 2 months that we've seen here, even given seasonal changes and everything, bad weather in January, why are those 2 months like swinging everybody on what the trend is?
Well, that is a good point because, we've obviously come down a long way depending on which one of the inflation metrics that you want to use. But clearly, we've made a lot of progress getting back closer to the Fed's 2% target. And I do think, especially as you mentioned, that, the seasonal in January tends to be, I would say, maybe distorted a bit to the high side. I think it was 2 years in a row where January was somewhat of an outlier. But it does seem as though, the employment picture is still somewhat out of balance, where there aren't enough unemployed workers to fill all the open positions. Some of the service sector inflation appears to be moving higher. If you look at the wealth effect with what's happening within the stock market, it does seem as though even residential real estate, it seems as though buyers are now a little more willing to accept 7% mortgage rates than maybe some of the sticker shock they had last year. So I just think there are a lot of factors that could keep inflation above the 2% target.
Surely there's so much that we don't know. Patience may be their key position here at the moment. They do have the math working in their favor, and it's working in the favor of the American worker as well, because inflation levels are well below the Fed funds rate at the moment. And the longer they wait, the more the lagged effect comes into effect, right?
Yeah, I mean, that is very true. And I was listening to an interview earlier this evening on Bloomberg with Larry Summers, and he was really calling into question the neutral rate projection by the Federal Reserve and the fact that they kept it basically at near 2.5% with last week's dot plots, and his estimate that it's somewhere above the 4% level today. So really, it's just a question of how restrictive the Federal Reserve is today relative to the neutral rate of interest, and I think there are a lot of secular forces that are at play here. So again,
but
I think
even if he's right, and that's pretty high, 4%. I think the Fed's at 2.6, up from 2.5. Even if he's right, the math is still working in your favor, right? Fed funds rate is 537.5, and so it's going to be a sort of tightening measure that stays in place as long as they don't actually start cutting.
Well, that is very, very true. However, if you sort of look at where the 10-year Treasury is today, for example, that's awfully close to a 4% neutral rate, if that is indeed the target. So, I think the slope of the yield curve is clearly making longer-term borrowing costs a lot lower. And if you just look at how easy credit conditions are today by certain metrics, and we spend a lot of time investing in the corporate bond market, investment grade and high yield spreads are really near the lowest levels since the financial crisis. So again, there are a lot of signals today that says that sort of this Fed forward guidance, this communication that's tilted clearly towards easier money has in fact already eased credit by
so
decent
do you
amount
feel pretty
since
comfortable
November.
do you feel pretty comfortable collecting those 7% or so yields on corporates?
Well, I will say we I think if you look at the absolute yield levels today, we think they look attractive, even if you think that, let's say, inflation sort of stays in that 3 to 4% range. So I think there are a lot of attractive opportunities in the corporate bond world today. Yes.
Mark, thank you. Unfortunately, tied on time. Mark Heppenstall, President, CIO of Penn Mutual Asset Management. Let's get to our guest, Mahjabeen Zaman, who is head of FX research at ANZ. Mahjabeen, thanks very much for joining us. Let's talk first about the Bank of Japan. It seems like what they did, it didn't quite work out because we've seen weakness in the Japanese yen. I mean, perhaps we can argue that it did work out and they sort of threaded the needle there. But then this morning you had the top currency official in Japan warning against speculation, saying that the action that we've seen here with the yen is not in line with the fundamentals. How do you see the yen moving against the dollar, for instance, over the medium term?
Look, I think over the medium term, we do see a little bit of strengthening in the yen, but in the short term, surely we think it will remain elevated. Dollar yen will remain elevated above that 150 mark. We have seen previously, over the past year, even verbal intervention usually doesn't have much of an effect. And at the end of the day, it's really those, dollar yen rate differentials that are the key driving factor of this currency pair. And we have seen the dollar stronger over the last week, and that's feeding into dollar yen.
One of the issues seems to be that a lot of central banks elsewhere around the world are looking to cut their rates at the same time that the Fed may be cutting its rates. And so, the strength that we saw in the dollar that we thought might turn into weakness with the Fed cutting now seems like it's actually keeping the dollar strong. And so it's hard for the yen to really rally against the dollar. We've got a lot of variables there, but do you see that other central banks and the Fed moving in sync keep strength in the greenback?
Look, I think in the short term, especially over the last few weeks, as you said, everybody's looking to cut. It's going to be the race to who cuts first and who cuts last. And possibly that's probably going to have some impact on the way the dollar moves. Of course, last week we had the S&B surprise. I think we had a little bit of that driving that dollar strength. We also had BOE now looking to sort of turn a little bit neutral. You could argue RBA, similar language. I think all of that has lent some support to the dollar. CNY, again, the fix was wider. So all of this lending support, but I think that's not going to be long lasting. We continue to maintain the view that into the year end, we're looking at the DXY at 98. So that's about 5+ % from here. And there are many different drivers for that.
I guess the basic math is the Fed raised more than everyone else. So it stands to reason that they'll probably eventually have to cut a lot.
Yeah, definitely. And I think it's a lot of things, right? I think we had U.S. exceptionalism help the dollar over the last 2 years, particularly. And, as you said, they've gone stronger as well on the rate side, so they have to cut more. But also, I guess, rest of the economies, you could argue about China, where maybe the green shoots are not really there yet. But then, in Europe, you're starting to see green shoots. The rest of the economies are now starting to look better. Sure, we've had technical recession, so-called. Japan was not really there. England's behind it, New Zealand, but that's all backward-looking stuff. Going ahead, I think the growth differential between U.S. and the rest is narrowing, and so I think that will help the currencies of the other economies as well going forward.
How do you see bond yields moving, particularly at the short end?
Look, I think bond yields, front-end yields are moving to the tune of what the Fed says and what the expectations are. We were at technical levels before. We're moving a little bit lower from there. And look, I think FX markets, which we look at, dollar is very strongly correlated to what front-end yields do. At some point, we think that should be moving south. As we get more data, we're getting PCE this week. That should give us some idea as well.
I'm a little surprised to see that you expect the Fed to cut 4 times, 100 basis points this year.
Yes, so we do. We are a little bit more, I would say dovish than the Fed themselves. And I think, inflation is coming down. Of course, we've had 2 months of higher inflation, but clearly Powell has pushed that back. From where we see, the communication coming from the Fed and the direction of the inflation, and also underlying data in the job market is starting to look a little bit softer, and all of that will warrant, that 100 basis points of easing this year.
Given the dovish stance that the Fed had, and admittedly, you're a little more dovish than the Fed, but still, in sticking with the 3 rate cuts, I would have thought that Powell might have been talking a little bit more about slight weakness in the jobs market. But instead, he seemed to be pretty confident in job creation and the fact that, it's pretty steady and pretty strong.
Look, I think it's the various indicators. Non-farm payrolls, of course, are painting a fairly stronger picture than the rest of it. When we look at the underlying data, when we look at the wage tracker, Atlanta wage tracker, and a few other, the job openings and all of that has retreated quite a bit. And I think that will play into the data as we go along. But, whether they go 75 or 100, surely, the Fed will be moving pretty soon. We think June will be when they start. July is when they will start.
I want to go back to the Bank of Japan because I've been thinking about this a little bit over the past week about whether or not it might have been smarter for them to say we're dropping yield curve control and we're going to stop the buying of bonds and some of the other changes that they put in place. Rather than what they did, which is they dropped yield curve control, but they said they were still going to buy bonds as they saw fit. And that's why the yen has weakened quite a lot. Do you think that would have been a step too far?
Yeah, I think so. And I think, it was a pretty dovish hike. And as you said, BOJ, they continue to maintain to buy bonds at the same pace they were buying previously. Now, this should keep its balance sheet steady. And I think Governor Ueda had mentioned that, again, not to shock the market, but, they will keep financial conditions accommodated when that's important. With regards to getting out of that negative rate environment, that was pretty much coming. And it was, I think, to me, I'm looking at it as a one and done. The wage negotiations really fueled the move a little bit earlier that we were first thinking April, but came a little bit earlier. Now, in terms of when they're going to move next, to be honest, we do see, the economic conditions in Japan are pretty weak. You look at consumption, it's pretty weak. We're looking at services PPI, which the board watches closely. That's also retreated. And when we look at inflation that came out last week, again, it's kind of retreating. So we don't think there's going to be a sequential rate hike story here. Maybe they might hike once at the start of next year, but that's dependent on how data moves. And also very difficult to be tightening when the rest of the world is in an easing cycle.
And I guess the final question on the Reserve Bank of Australia, a little bit less hawkish, but still more hawkish than many other central banks. What does the outlook look like for the RBA going forward?
Look, I think the shift towards, I guess, as you said, less hawkish was coming. And that's really because, we've had monthly CPI data coming out, which seems to be retreating. We look at, inflation from all elements, and surely it's painting the right picture for the RBA. Having said that, locally here, we are expecting some fiscal easing coming through in form of tax cuts. Starting from the middle of the year, we think that the RBA may want to see the result of that on consumption and GDP before shifting the dial. And so when we look at, they're probably one of the most hawkish within the G10, and we expect them to only start cutting in November for the first
Just briefly in 20 seconds, do you think that oil prices will continue to rally?
Yes, I think so. I think the demand side of the story from China is picking up. Again, that's been supportive, and supply side is retracting. So that points to higher oil prices.
Yeah, we saw China's oil demand in January and February, those 2 months, pick up 6% from a year ago. And that does seem to be adding to some of the demand pressures. Thanks very much to Mahjabeen Zaman from ANZ. This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.